topic focuses on foundations, endowments, and the evolution of the endowment investment model. Endowments are pools of capital established to support institutions, such as universities, hospitals, and museums in perpetuity, while foundations are nonprofit entities created for charitable purposes and often subject to minimum annual spending requirements. Both institutions aim to balance long-term growth with ongoing distributions, making strategic asset allocation central to their success. The topic emphasizes that alternative investments have become increasingly important within institutional portfolios because they offer diversification, inflation protection, and opportunities for enhanced returns. However, these benefits must be balanced against liquidity constraints, governance requirements, and long-term spending obligations. The program distinguishes endowments from foundations by examining their structure, objectives, and operational characteristics. Endowments are generally designed to maintain purchasing power indefinitely, using investment income to support operating activities while preserving the original corpus. Foundations, on the other hand, distribute grants or fund charitable activities directly and often operate under mandatory spending requirements to retain tax advantages. The topic identifies several foundation types, including operating, community, corporate, and independent foundations. Independent foundations frequently originate from concentrated gifts of appreciated securities, creating diversification challenges and unsystematic risk. Despite structural differences, both endowments and foundations share common investment concerns involving inflation, liquidity management, risk tolerance, and sustainable spending policies designed to support future beneficiaries. A major concept within the topic is intergenerational equity, which refers to balancing current spending needs with preserving sufficient capital for future generations. Institutional investors must determine spending rates that support ongoing obligations without eroding the real value of the portfolio over time. Inflation significantly complicates this process because spending policies must account for rising costs while still maintaining purchasing power. Excessive spending rates may benefit current beneficiaries but reduce future financial stability, whereas conservative spending rates may preserve long-term wealth at the expense of present needs. The program explains that many endowments target returns exceeding inflation by a specified margin to sustain distributions, maintain operational stability, and preserve real asset value over extended investment horizons. The endowment model represents a long-term investment strategy emphasizing substantial allocations to alternative assets such as private equity, hedge funds, venture capital, timberland, and real estate. Popularized by large university endowments, the model seeks superior risk-adjusted returns through diversification, illiquidity premiums, and active management opportunities. The topic notes that large endowments historically outperform traditional portfolios due to several factors, including aggressive asset allocation, access to skilled managers, sophisticated governance, strong alumni networks, and acceptance of illiquidity risk. First-mover advantages and advanced investment research capabilities also contributed to superior performance. The model generally underweights traditional fixed-income investments because of their relatively lower expected returns and limited inflation protection compared with alternative investments and growth-oriented assets. Despite its historical success, the endowment model carries significant risks that became especially visible during financial crises. Large allocations to illiquid assets can create liquidity shortages when institutions must continue spending during periods of declining portfolio values. Leverage, valuation uncertainty, and dependence on private market financing may further amplify risk during stressed market environments. The program highlights the relationship between spending rates, liquidity demands, and portfolio sustainability, emphasizing that institutions relying heavily on illiquid investments may become liquidity-driven investors during crises. Effective risk management therefore requires careful stress testing, contingency planning, and maintaining sufficient liquid reserves. Institutions must also recognize that higher allocations to alternatives increase operational complexity and demand more sophisticated governance and investment oversight structures. The topic concludes with discussions of liquidity rebalancing, tactical asset allocation, and tail risk management within institutional portfolios. Tactical asset allocation differs from strategic asset allocation because it deliberately deviates from long-term target weights to exploit short-term market opportunities or reduce risk exposures. Liquidity rebalancing allows institutions to maintain target allocations efficiently, sometimes using derivatives to reduce transaction costs and improve flexibility. Tail risk management is particularly important for endowments because extreme market downturns can severely impair funding capacity and operational stability. Common tail risk strategies include increasing allocations to high-quality government bonds, purchasing protective put options, and using volatility-related hedging instruments. These approaches help institutions preserve capital, maintain liquidity, and continue supporting long-term organizational objectives during periods of severe market stress.